What we're going to be going over here is the amortization of prior service cost on a pension plan here, and we're going to be using the StraightLine method to amortize this prior service cost or to determine what the service expense is going to be for this amendment here. So this is the case where the company is going to amend their pension plan here, and what they're going to do here is they're going to grant $80,000 worth of extra retroactive benefits here for the pension to the current employees that are under this pension plan. So this is what we call, they're going to grant $80,000 worth of prior service cost to these employees. So this is what we're going to be looking at here. I've got them grouped here. We're going to have 5 groups of employees, A through E here, and the number of employees in each of these groups here I'm showing here. So like group A here, there's 40 employees in this group, and what they're going to do is they're going to be expected to retire here in 20X1, and then I've got them listed here for the other groups here. So number of employees and their expected retirement year here. That would be the end of the year here. So here we got 170 employees, and we have to allocate this $80,000 here to their prior service years or service cost here. And this $80,000 here was granted here in year 20XO, or the previous year here. So this is what we have to do here. So first thing we have to do is we have to go out and we have to determine what the total service years to be worked for by these employees. So what I've got it showing here. This is how you'd lay it out here. You take your years, or year X1 through year X5, and then you'd have to determine your total service years based on the number of when they were going to retire here. So this group of, for this first year, year X1, all the employees would have worked here. Group A would retire at the end of the year here, but they would be included in the service years worked. So Group A we would have shown here at 40, and then the rest of the numbers here, rest of the groups would have been, the number of employees would have been included. So we have a total of 170 employees here that would have worked here for year X1. But year X2 comes around here, and Group A would have retired here at the end of the year X1, so they wouldn't be included. So all you do is take your Group B here through Group E, and your total number of service years worked for those employees would have been 130 here, and then so on down here. When you move to year X3, Group A and Group B would have retired, so all you have is Group C through Group E for a total of 110 service years worked. And then year X4, well, you just have groups D and E that would have worked here for a total of 70 years. And then year X5, well, Group E would have worked that whole year here, and they would have retired at the end of the year here. So you see what's going on here. Each of those years here, you have to look at the number of employees, or the employees that would have retired in the previous year here, and they wouldn't be included in the next year here. So that's how that works out here. So to determine the total service years worked, just sum your total years here, year X1 through year X5. You're going to come up with 500 years here of total service years to be worked that we're going to have to allocate this $80,000 over here. Now, I'm also showing here groups A, B. You could add them up here vertically too. So whatever you have for each of those groups here, for each of the years that they would have worked, you can total it up that way. You're going to come up with 500 service years here. So the second thing we have to do is we have to determine the average service expense per year here. So we know the total service years worked by these 170 employees. That was that 500 years here. Now we have the 170 employees. You divide that into the 500 years of total service years worked, and on average, each employee would have worked 2.94 years here. So that's how we're going to allocate our retroactive benefits here. So you take that retroactive $80,000 worth that's being granted here to these employees, divide it by the average service years for each employee here at 2.94 years, and you're going to get an average service expense here of $27,211. So I'm just showing it here. First, we had to calculate the average number of years that each of the employees would have worked here, and then we just take whatever grant in this, whatever benefit they were given. In this case, it was 80,000 divided by the average number of service years each would have worked here. That gave us our average service expense. Okay, so now using the StraightLine method, what we have to do is, well, we start out with each year here, on average, we determine that to be average service expense was $27,211. So what we would do, we have the total of 2.94 years. So for year X1, well, we get to just take 1 year times our average service expense. That give us our annual expense, or what we're amortizing each year here at $27,211, and then move on here year X2 again, 1 year here, $27,211. But this is where we have to take care of that fractional part of that third year here. So this, in this case, you've assigned 2 years here, so you just take the remaining amount here times your third year in this case, and that's 0.94 here times the cost per year, $27,211. You're going to come up with $25,578. So this is what you're going to amortize each of those next 3 years here, year X1 through year X3. So total amount here, annual expense was $80,000. Okay, so this is using the straight line method here to determine the average service expense that you're going to be expensing out here for the pension plan amendment where they were granted this extra $80,000. Okay, so now let's go down and let's just look at how we make our entries here, our journal entries. So the first thing we have to do, we have to deal with this account here, and we could go through each of our accounts here, and we will. There's 4 different accounts used in these pension plans, and I got it laid out in a worksheet format here for pension accounting. But first, we're going to look at just this straight line method here for amortizing this service expense. So we start with our other comprehensive income. Now this is for our prior service cost. This is for a prior service cost, and this is an equity account here on a balance sheet here. This is an equity account. I'm showing the debits and credits here. So first thing you have to do is you have to reduce your other comprehensive income for the amount that you granted here. This was granted here in year XO here. We granted $80,000 worth of extra benefits to the employees here. So you debit or you reduce your other comprehensive income here on your balance sheet here in your equity section. And that's at the grant date here for the prior service cost here in year 20XO, or the base year here. And then, okay, so we've got our debit here of 80,000. Everything is shown in thousands here. Now we have to move over to our other account here, where this is a memo account here. This is the projected benefit obligation here. So we reduced our other comprehensive income. Now we would be crediting or increasing our liability account here for that prior service cost. Credit it here for $80,000. So that goes against the projected benefit obligation, because that $80,000 here is what company's going to have, is obligated to pay to the employees as they retire here for that money that they granted for their previous service. So prior service cost here. Okay, so we've set up that here. We reduced, let's move it back here. Okay, for other comprehensive income on our equity section here on our balance sheet, reduced it here by $80,000 for at the date that it was granted. Now comes along what we have to do here in this other comprehensive income account. We have to account for the amortization of this prior service cost, and we're just looking at our year X1 here. Just looking, we remember we had 3 years here. Let's just look at year X1, and this worksheet is laid out for year X1 for everything. So we have the annual expense that we calculated here at $27,211. So what we would do here, we would actually credit or increase other comprehensive income for that amortized or that service expense here for the year here by $27,000. I'm just rounding it off, $27,211 here, just rounding it off. So remember, we started out with a debit here. We reduced other comprehensive income for the total amount of that service cost. Now we just amortize it down here for the first year here. We would credit or increase our other comprehensive income by that amount. So at the end of the year here, well, those are the only activities we had. At the end of the year, what we would have for year X1 here, sitting on other comprehensive income for this amortization here of this prior service cost, is just the net amount here. We had the $80,000 debit here, credit here for other comprehensive income here at $27,200. So we sitting with $52,800 here in our other comprehensive income. So we actually reduced our other we actually we credited or we increased it here due to the expense that we recognized for the first year here, but we ended up with a net amount here that's a reduction over what we started. So that's the key that you're having to look at here. And then if we look at this, we had the credit here to the other comprehensive income. Where would the debit go? So let's move over here. In this case, it's going to go against our pension expense for the year here. So we debit or increase our pension expense here on an income statement. And that's our annual expense here by $27,200 or $211. I'm just showing it rounded off here. So we've looked at our amortization here just using the straight line method. We could go through this problem, just look at our other accounts here just to understand what's going on with this pension accounting, and maybe we should do that here. So let's just go and let's look at the case here and this is just a typical problem here for we had starting with our account here for our pension expense, we had some service costs here, $90,000, some interest cost of $70,000, and those would be increasing or debited to our pension expense here. And then we had a return here on our plan assets of $64,000. So that we would be crediting to our pension expense or reducing our pension expense because we had a return on our plan assets. And then we had the debit or increase in our pension expense due to the amortization here, that prior service cost of $27,200. So our net amount for the year here in our pension expense will be $123,200 or $200 rounded off here. That's for year X1. Okay, and then if we move over to our cash account here, we're going to have our pension contribution. That's the only thing that's going on in our cash account. So we were going to reduce our pension contribution by $105,000. So that's what company's going to pay towards the pension for the year here. So total amount of in our cash account for year X1 here would have been a credit or a reduction here of $105,000. Now we move over to our other comprehensive income. We already went through that here. The debit to the amount that was granted here for that prior service by the employees for the pension plan of $80,000. Then we had the amortization here for the year of the pension expense, credit or reduce what our other comprehensive income was of $80,000 by $27,200. We ended up with the balancing amount here at the year X1 of $52,800. Now we move over to, let's move it over here. We're going to go and we're going to have our what we call our pension liability here, and pension liability is going to be based on those first three accounts that we looked at: our pension expense, our cash account, and our other comprehensive income. Plus, we have these other accounts that we keep track of here. We have to keep track of our pension benefit obligation here. That's a memo account, a liability here. And then we also have our plan assets, again, a memo account, and these don't go directly into the journal entries here for pension accounting, but they're kept in a memo form, and that keeps track of the assets we have on our plan in this pension plan. Okay, so let's just look real quickly here. So let's look at how we work through this here. With pension benefit obligation, again, our liability, let's just say in this year 20XO here, that first year here, we had a credit amount here of $620,000 as a PBO obligation here. And then our plan assets, we had a debit amount here, or an increase in our plan assets at the end of the X year here, first year XO here, of $640,000. So what we would do here for that pension asset, what we would do is we'd be debiting that here for $20,000. And that's really the difference between our pension benefit obligation and our plan assets here, $640,000. Okay, but these are the guidelines that we have to work with here. If the PBO or the pension benefit obligation is less than our plan assets, then the pension liability here we'd be increasing it here, or it'd be a pension asset as we call it here. And you can see that's the case here. So our plan assets of $640,000 is greater than our projected benefit obligation of $20,000, so we would be debiting that here for $20,000. It's not really a balancing entry. You have to follow the guidelines that we were using down here. Now, if the pension benefit obligation was greater than the plan assets, then it would be a pension liability, and that isn't the case here in our problem here. Had this projected benefit obligation here been greater than the plan assets, or the amount that we have in our plan assets, then we would have credited, or it would have been a reduction of a pension asset here, or it would have been an increase in our pension liability in the account that we keep track of it here. So this is the account that you're going to keep track of. The balance account here between your projected benefit obligation and your plan assets, and the other three accounts that we're going to be using here. And then if we move down here, let's just look at follow through a year here. So we had this prior service cost. We would have credited here for $80,000 here for the year 20XO here. So we start out with our beginning year 20X1 here, $700,000 here. And that's in our PBO account here, but our plan assets would have remained at $640,000. So that's at the beginning of the year here. And then for a projected benefit obligation, service cost, it would have increased here, credit that here for $90,000. The interest cost here on this pension plan of $70,000. And then we can move down here. And this is where there's going to be benefits or payments paid to the retirees here. So what we would do, we debit or reduce our PBO, or pension benefit obligation, by, in this case, it was $40,000 here for the year. And then what we would do here, just looking at, we're going to figure out what our end of year X1 is here. So you just start out with your beginning amount here of $700,000. Remember, that's the amount here after the prior service cost was credited, or it was increased here for the prior service cost. So that gave us our beginning of the year amount. Just sum total all your service costs, your interest costs, then reduce it by the payments that are paid to the retirees here. You get your end of the year balance here at $820,000. Now if we move over to our plan assets here, we'd be looking at that here. How did that fall out here? So we started with our beginning balance here, $640,000. Now we had a return. Remember, there was a return on those assets here, and that was a reduction to our pension expense account here, and that would be a debit or increase to our plan asset account. So when your plan assets accounts was increased by $64,000, and then remember, we had a contribution. A cash account was reduced by $105,000, and that was paid to our contribution here to our plan assets. So we debit or increase our plan assets here by $105,000. And then we have these payments to retirees. Let's just say we had the $40,000 here that we reduced our projected benefit obligation here because we paid it out. We don't owe it anymore here. But in this case, it was a reduction, direct reduction to our plan assets, because those were the payments that were made. So our plan assets would have been reduced. So then just doing your sum total here, just looking at your beginning amount, $640 plus your $64,000 return, $105,000 contribution here, debit amounts, and then the reduction here due to the payments to retires of $40,000, you end up with the end of the year balance here of $769,000. Okay, so now we can go and we can determine what's sitting in our pension asset and liability account here. So all we do here, in this case, we're going to go through these guidelines here again that we use, the PBO versus our plan assets. So we're sitting here, end of the year here, our pension benefit obligation is now $820,000, and our plan assets are now sitting at $769,000. Remember, in the beginning here, our projected benefit here was less, or is less here than our plan assets. So we had a pension asset due to that here. Now we're going to look at just the opposite here. Our projected benefit obligation, $820,000, is greater than the plan assets here of $769,000. So this is where we're going to determine whether it's a pension asset or a pension liability here. So in this case, the pension benefit obligation here of $820,000 is greater than our plan assets here of $769,000. Then we're going to have a pension liability, and that is going to give us $51,000 here in a pension liability. Okay, so now we can determine what we had to look at our end of the year balance here, and this is the adjustment that we have to make, and this is what's going to be recorded here on our balance sheet here. So we're going to determine this balance to be year end here for X1 is $71,000. It's not the $51,000 here. It has to be $71,000 because we have to look at what we started with here. In our pension asset liability account, we had a debit here at $20,000, and we have our ending balance here based on our PBO here and our plan assets of a credit here of $51,000 here. We have a liability here of $51,000 because, again, because our PBO here, $820,000, is greater than our plan assets here, $769,000. So the only thing we can come up with here for year X1 is the $71,000, because the $20,000 here in our pension asset here reduced our end of the year balance down to $51,000. So $71,000 would be the balancing amount, or the amount that we have to plug in here to make everything balance out. So that's how you determine your pension asset and liability account. You have to do some calculations here. You have to determine what's sitting in your pension benefit obligation here and your plan assets at the end of the year, and then look at what's sitting here in your pension asset or liability account here at the beginning of the year. There's also another way, we back through it here using the PBO and the plan assets here, but technically here we can look at it in a different fashion. So if we would go down here and we look at it in this fashion here, we had a pension expense of $123,200. We had a debit to that. If we went up and looked at it, we had a debit sitting there. And then our other comprehensive income, we can look at that real quick here. We had a debit amount here of $52,800. And these are the four accounts that we're going to be using here to record our journal entries here. So we look at our pension expense here, the $123,200, plus our other comprehensive income debit amount here, $52,800. So what we would have to do is now we have to determine our credit amounts here. Let's say we didn't know that this was $71,000 here, but we do know what our cash funding was. We would have credited our cash account here. We can go back and look at that here. Reduced it here by $105,000. So we have $105,000 sitting in our cash account here, and then we have those debit amounts here sitting in our pension expense and our other comprehensive income. And what would that be? A total here of $176,000, and then we have the credit here, cash funding, $105,000. So our pension asset, we have to have another credit amount here to balance everything out. That would be $71,000 here. So that's the second way we can, actually it's the preferable way here to determine what's sitting in your pension asset and liability account. And this $71,000 here, the balancing amount here for your four accounts that we're going to be actually making our journal entries here, should be balancing with our projected benefit obligation and our plan assets here account, both as memo entries or supplements to our journal entries. Okay, so let's go back and let's look at how we'd be recording this here for the end of the year here. And this is where we're playing with this other comprehensive income here for those prior service costs here. So let's go back and let's look at it over here. Let's move over here. Okay, so we're looking at our journal entries here for 20X1. Now, our journal entries here on our balance sheet, they don't really involve, well, we're not using the projected benefit obligation as a journal entry or the plan assets. Those are memo accounts, but this is what we'd make here for our journal entries. So we take and debit our pension expense. Let's just go look at that here. Here's our pension expense. We had a debit amount here of $123,200. So that we would debit here. These are the journal entries year 20X1. That's why we figured out here at the end of each year here 20X1 for each of those accounts. Then our other comprehensive, we had income. We had a $52,800 in here, and that was for that prior service cost. We would have had a debit here of $52,800 for other comprehensive income, and then the credits would go to our pension liability. Remember, we had that here, and we can go look at that here. That we had a credit here of $71,000, not the end of the year balance in this case of $51,000 based on our projected benefit obligation, our plan assets, but what we needed to balance out here based on our beginning amount here, a debit of $20,000 that we had up there. So we would have had that credit, go back here, credit our pension asset and liability for $71,000, and then the last thing was our cash account here. We had that credit here, $105,000 worth of funding for our funding our asset account here, our contributions for the year here. So we credit our cash account here for $105,000. Okay, so what we've done here, we just went through these journal entries. This is what would be recorded here when you're dealing with these typical pension account, pension problems here when you have to determine how to record on your balance sheet here, and we looked at year 20x1. Okay, so that'll really summarize our problem here. Just remember, we can move it up here to other comprehensive income here, the OCI, and that's for this prior service cost, and we use the straight line method in this case here to determine how we would enter our service cost, our prior service cost, based on that extra $80,000 that was granted to the existing employer, the employees under this pension plan. Just remember here, you have to debit or reduce your other comprehensive income by the amount that was granted here. That's at the grant date here. And then each of the years here, what you would do here is you start out with your reduction. You immediately take your reduction for these. You recognize this other comprehensive income here as a liability here for your projected benefit obligations. But each of the next years here, you would take whatever expense you had and you'd be crediting or you would be reducing your prior service cost debit amount here by whatever the service expense based on that grant amount here would be. You'd be crediting that each year here, or you'd be increasing your other comprehensive income for the amount of that amortization here of prior service cost. And then remember, at the end of the year here, you just net your whatever's sitting in your beginning balance here, whatever you have in your whatever you have for your crediting here for your prior amortization, your prior service cost is going to give you whatever balance you need here at the end of the year here in your other comprehensive income. Okay, so that just goes over our typical problem here for pension accounting here, and this is where we amortize the prior service cost here based on using this straight line method.